What's up YouTube? Dougie Chong here. In today's episode, I'll be taking a break from the stock review videos and covering 3 scenarios when you should use an RRSP, TFSA, or a regular cash trading account. There are many reasons to use each of these 3 accounts, but I'll be going over 3 very specific scenarios that I personally use when deciding which account I should use. Again, this is just what I personally do. There's no right or wrong answer to which account you should buy a stock in. The 3 scenarios I will be covering in this video are if you are looking to buy a high-risk dividend-paying stock, a high-risk growth stock, or a low-risk growth stock. The definitions for growth and risky, that is subjective, but I'll leave that up to you to decide if it falls under one of these 3 categories. So I'll start the video off with a brief overview of what an RRSP, TFSA, and a regular cash account are. I don't really have to go over the cash account, it's just a regular non-registered account. But RRSP, you basically get a certain contribution limit per year based on how much money you make, and then you can only pull the money out when you retire. All the gains in this account are tax deferred, which means if you take a gain in a certain year, you will not pay it until you pull the money out in retirement. A TFSA account, on the other hand, is tax-free forever. So all the gains you get in this account are tax-free. On the other hand, your contribution limit is only around 5 or 10K per year after your 18th birthday. I'll leave links in the description below where I go over these accounts in more detail. I'll apologize, they're a bit older, the quality is not quite as good. I'll probably be looking to remake these videos in the near to short term future. Leave a comment if you want to see me go more into depth into RRSP and TFSA accounts. Alright, now let's start with scenario 1. You're looking to buy a high risk dividend paying stock. This was actually the motivation for me to make this episode. I was looking at the stock ticker symbol CCL, which is Carnival Cruise Lines. It's a pretty risky play now with the whole health situation going on, but they are a high risk dividend paying stock. Right now they cut their dividend, but in normal times they pay a pretty hefty dividend. Alright, so now which of the 3 categories should this go into? RRSP, TFSA, or a regular cash account? For me, I put this under my RRSP account. I did this through the process of elimination. I do not want to use the cash account because if I use the cash account, I would be taxed on the dividends every year. Now this isn't necessarily a bad thing if you need some cash in the near term future, but it's much better usually to get your gains in the form of capital gains and then you have to pay the tax many years down the road. It's also fairly troublesome if you do your own taxes, and especially if you have it across multiple different accounts. It comes on a different form than the form of your capital gains, and it comes much later. So from an accounting perspective, it's much better just to put it in an RRSP or TFSA account. You don't have to deal with any of that tax hassle. So why did I pick the RRSP over the TFSA? Well, this comes down to the risk factor. Since it is a higher risk stock, I am looking at the account that I am willing to take a loss in. And for me, the TFSA account is like the golden goose account. It is money and gains that will be tax-free for the rest of your life. So for that reason, I want to maximize my TFSA as much as possible and minimize the risk. I am more willing to take a loss in the RRSP account, which I will have to pay tax on when I retire, and it has a lot of more time to recover in the event that the stock does go down. I'll throw in a few bonus tips with this scenario. If you are buying a US dividend stock, it is also more advantageous to put in the RRSP over the TFSA because you will not be charged withholding tax. The withholding tax is about 15% of the dividend and is charged to any investor that does not live in the United States. And the second bonus tip, if it's a US stock, is that you can open a US dollar RRSP or TFSA account. I recently learned that you could open a US dollar TFSA account. This will save you the approximately 2% foreign transaction fee that most brokerages will charge you. It's important to note that not all brokerages offer US dollar accounts. The big banks like TD and CIBC do, but this is one disadvantage of Wealthsimple where they do not have US dollar accounts yet. Alright, so that sums up for high risk dividend stocks you would put in an RRSP account. Now with all 3 of these tips, this goes on the caveat that you're maxed. You're pretty close to the contribution limits of your RRSP and your TFSA account. If you just have boatloads of room in your TFSA account, I suggest you max that out first or come close to maxing that out, because that is tax-free gains forever, as opposed to RSP, which is just tax deferred. Alright, now let's get into the second scenario of high-risk growth stocks. Now, what exactly are high-risk growth stocks? These are companies like Netflix, Roku, or Tesla that are not very profitable now, but are growing like crazy. It can be very tempting to fill your TFSA account with these high-risk, high-growth stocks in a TFSA maximizer strategy. Basically, you're going big or you're going home. And if it works out for you, then it can be great. You'll end up with a 7-figure TFSA account and you'll be featured in news articles. But on the other hand, it cannot work out. Your investments can plummet, and that's just because it's a high-risk stock. And this is what happens for about 90% of people, and it's what the news outlets don't cover. They cover the one guy that managed to get his portfolio to $1 million, and they don't cover all the other people that lose tens of thousands of dollars. Now, I'm not saying don't buy any high-risk, high-growth stocks in your TFSA account. Maybe put like a smaller percentage, but the majority of them should be in your regular cash account. This is also advantageous because in the event that the stock does go down and you do take a loss, you can count it against your wins for tax purposes. But probably the main reason why you should avoid using your TFSA account is that the contribution room will never come back. Let's say you put 10K in your account and then it lost, it went down to 5K. You'll never get that 5K contribution room back, ever. Your contribution room will only go up 5 or 10K depending on the year past your 18th birthday. This contribution room argument also works for RSP, but a little less so because depending on the amount you make per year, your contribution room can be around $20,000. So for high risk growth stocks, we have that going in the cash account. Now let's move on to the third and final scenario of a low risk growth stock. Now you might be saying that this is an oxymoron. How can a stock be both low risk and a growth stock? The definition of a growth stock is almost inherently that it's a risky stock because the company is still growing. Their business model has not matured and it is not proven yet. But basically, I would consider companies like Amazon, Facebook, or Apple to be low risk growth stocks. This is because while these companies are some of the largest by market cap already, like how much can they possibly grow, they are still growing in other spaces. Amazon is trying to move into the grocery sector, and Apple is trying to move into the TV sector with their Apple TV product. And I think their risk profile speaks for themselves. Amazon, even at the heart of this health crisis, is at all-time highs around $2,400 now. So that's my rough definition of a low-risk growth stock. I know the Apple stock has a dividend, so maybe you put it in that dividend category, but it's a fairly small dividend, so it's not that big at the end of the day. So where am I putting low-risk growth stocks? I'm putting them in my TFSA account. Since the risk profile is lower, I can be fairly confident that my contribution room and my TFSA gains and tax-free gains will not be wasted. The trade-off as opposed to high-risk growth stocks is that you won't see the huge returns as much as 5 or 6 times in a matter of a few years that Netflix or Roku might have, but you'll see maybe 2 times, possibly 3 times in a 2-3 year time span. Alright, time for the overall summary. We got high-risk dividend stocks. We put those in the RRSP. Then we have high-risk growth stocks. We put that in the regular cash account. And then we have low-risk growth stocks. We put that in the TFSA account. I'd like to reiterate that that's just my opinion. This is what I personally do. I'd love to hear what you guys think in the comments below. Also, I'm not a licensed financial advisor. This is not legal financial advice. That's it for this video, guys. Thanks a lot for watching. Hope you learned a lot about which account you should put your stocks in. Leave a like if this video helped you at all, and don't forget to subscribe if you have not already. I'll be returning to my regular stock review videos in the next video. Enjoy the rest of your weekend and see you in the next episode.